Have you ever looked at a company's financial report and thought, what am I even looking at? Don't worry, you're not alone. But what if I told you that reading financial statements is not just for accountants or Wall Street pros? In fact, it's one of the key tools Warren Buffett himself uses to find winning stocks. In this video, I'll walk you through how to read financial statements like Warren Buffett, even if you're a complete beginner. We'll cover the 5 key financial ratios Buffett watches closely: profit margins, return on equity, debt to equity, price to earnings, and price to book value. You'll also learn the basics of the balance sheet and income statement, so you can finally understand what makes a company financially healthy or dangerously risky. So grab your coffee, get comfy, and let's break down the world of financial statements in a way that's simple, clear, and even fun. You'll never look at a stock the same way again. Let's get started. Let's start with one of the most important financial statements, the balance sheet. Think of it like a snapshot of what a company owns and owes at a specific point in time. On the left side, you've got assets. This is everything the company owns, whether obtained from its own funds or from debt. The examples of assets are cash, buildings, inventory, or even unpaid customer bills. On the right side, you'll see liabilities and equity. Liabilities are debts, money the company owes to banks, suppliers, or bondholders. And equity is what's left for the shareholders after all debts are paid. It's sometimes called the company's net worth. Now, let's say Kent wants to start a company. He plans to open a kiosk that sells coffee, and he names his business The Daily Cup. Kent has $40,000 in cash. However, he needs $43,000 in total to start the business. That means he's $3,000 short. So he borrows the remaining $3,000 from a bank. Now let's take a look at how his balance sheet looks. Kent has $40,000 in cash of his own, which means he has $40,000 in equity in the form of cash. Then, he borrows $3,000 in cash from the bank, which becomes a $3,000 liability, also in cash form. And voila! Kent now has a balance between the left side, assets, and the right side, liabilities plus equity. That's why it's called a balance sheet. Warren Buffett loves companies with strong balance sheets, meaning they have more equity than debts, just like the Daily Cup's balance sheet now. Next up is the income statement, also called the profit and loss statement. This one tells the story of how much money a company made and how much it spent over a period of time, like a month or a year. At the top, you'll see revenue. This is the total money earned from sales. Then, the company subtracts all kinds of expenses, like costs of goods sold and general and administrative expenses. What's left at the bottom is the net profit or net income, or what Buffett calls the bottom line. Now, let's say that Kent's company, the Daily Cup, has generated $100,000 revenue during the first year and has spent $45,000 of cost of goods sold and spent $35,000 of general and administrative expenses. It means that the company earns a net profit of $20,000. What kind of income statement does Warren Buffett like? A company with growing profits over time usually means it's doing something right, and that gets Warren Buffett's attention. Let's talk ratios, the numbers Warren Buffett watches like a hawk. First up, profit margin. This tells you how much profit a company keeps from every dollar of sales. If a company earns $100,000 and keeps $20,000 after all costs, that's a 20% profit margin. Buffett loves businesses with high and consistent profit margins because it shows they have pricing power and efficiency. Think of companies like Coca-Cola or Apple. They don't just make sales, they make serious money from those sales. Next is ROE, or return on equity. This shows how good a company is at turning investor money into profit. For example, The Daily Cup has $40,000 in equity and makes $20,000 net profit. That's a 50% ROE, which is $20,000 net profit divided by $40,000 equity. Buffett looks for ROE above 15%, especially when it's steady for many years. That's a sign of smart management and a durable competitive advantage. Warren Buffett isn't a fan of debt. That's why he checks the debt-to-equity ratio, or DER. It tells you how much debt a company is using compared to its own capital. The Daily Cup has a DER of 3,000 per 40,000, or 0.075. That's below 2.0, which means healthy. But if it's over 2.0, that's a red flag. Too much debt means trouble during economic downturns. Buffett prefers companies that fund growth with profits, not borrowing. PR stands for price to earnings ratio. It shows how much investors are willing to pay for each dollar of profit. Now, if you could buy a company that earns $20,000 a year and you didn't have to do anything at the company, then how much would you buy it for? Assuming the business risk is very low. Please think for a moment. If you would buy the company for $400,000, then it means the price to earnings ratio is 20, which is $400,000 buying price divided by $20,000 earnings. But if you would buy the company for $200,000, then it means the price to earnings ratio is 10, which is $200,000 price divided by $20,000 earnings, and so on. A PER of 10 means you're paying 10 times of what the company earns in that single year. Therefore, the bigger the PER is, the more expensive is your buying price compared to its earnings. In general, a PER of 10 or lower is considered desirable. There you go, you've understood the concept of price to earnings ratio. Price is the money you pay to buy one share, and earnings are the money your company gets per each share. Buffett doesn't chase high PER stocks. He prefers low to fair valuations on high-quality businesses. In his words, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Last but not least, PBV, or price to book value. This compares the stock price to the value of the company's real or net assets. Real or net assets mean assets minus liabilities. Let's say you buy the Daily Cup for $200,000. As you can see, the Daily Cup's net assets value is $40,000, which is $43,000 assets minus $3,000 liabilities. Therefore, the price to book value is 5, which is $200,000 buying price divided by 40,000 net assets value. A PBV of 5 means you're paying 5 times of what the company is worth on paper. Therefore, the bigger the PBV is, the more expensive is your buying price compared to its worth on paper. In general, a PBV of 1 or lower is considered desirable. Buffett uses PBV more for banks and asset-heavy companies. He likes a low PBV only if the business quality is still high. It's not about being cheap, it's about being smart. Now that you understand the key statements and ratios Warren Buffett relies on, the next step is applying them to real companies. In the next section, we'll break down an example using a famous stock so you can see exactly how Buffett might think. Stay tuned. Let's put all these ratios into action and analyze a company Warren Buffett has loved for over 30 years. Coca-Cola. Ticker symbol KO. We're going to look at 5 key ratios to see how strong it really is and why Buffett has held it for so long. First, profit margin. In 2024, Coca-Cola had a net profit margin of around 23%. That means for every dollar they earn, they keep 23 cents in profit. That's extremely healthy, and it shows their ability to maintain pricing power. Because, let's face it, people will pay a premium for that iconic taste. Now, look at return on equity. Coca-Cola's ROE is consistently over 40%, which is off the charts. It means they're very efficient at generating profits from shareholder money. That kind of consistent performance is exactly what Buffett looks for in a long-term investment. What about debt? Coca-Cola's debt-to-equity ratio is around 1.5. That means they use some debt to grow, but not recklessly. Buffett is okay with moderate debt as long as the company has strong, stable cash flows, which Coca-Cola definitely does. Next is the price-to-earnings ratio. Coca-Cola trades at a PER of around 23. That's not dirt cheap, but it's not outrageous either for a blue-chip company with consistent earnings. Remember, Buffett's not chasing the lowest price. He's paying fair prices for great companies. Finally, PBV Coca-Cola has a PBV around 12, which is high. But Buffett doesn't worry about book value for companies with strong intangible assets like brand, distribution, and loyalty. In other words, the value isn't just in the factories, it's in the brand that's instantly recognized across the globe. To sum it up, Coca-Cola has high profit margins and excellent ROE. It manages debt well. While the stock isn't cheap, it represents quality, predictability, and brand power, things Buffett loves. That's why he's held it since the 1980s and still hasn't sold. Now it's your turn. Try picking a company you like, maybe Apple, Google, or even your local favorite stock, and plug in these 5 ratios. The more you practice, the more natural it will feel, and the better investor you'll become. And there you have it. You now understand the key financial statements and the exact ratios Warren Buffett uses to decide whether a company is worth his money. You've seen how he looks for strong profit margins, high returns on equity, manageable debt, and fair valuations. More importantly, you've learned that reading financial statements isn't just for experts. It's a skill any investor can learn, starting today. So if you're a beginner or even a so-called dummy, remember, the greatest investor of all time reads the same public info that you have access to. The difference is, he knows what to look for. And now, so do you. If this video helped you learn something new, make sure to like, subscribe, and hit that notification bell so you don't miss the next one. In upcoming videos, we'll explore more about financial statements and investment, dig into real companies, and teach you how to build your own long-term investing strategy step by step. Until next time, take care.